Welcome back to Strongman Personal Finance. We got a sponsored video today. Somebody paid me $50 to give my thoughts on Public Storage. If you want a sponsored video, look at the pinned comment below. Public Storage is a publicly traded real estate investment trust that offers storage services to people in the United States and internationally. A real estate investment trust is a tax structure where basically all of the profits are paid out as dividends to the holders of the real estate investment trust. They can't basically keep any of their profits inside of it. And the profits are taxed at the recipient's ordinary tax rate. The reason that is because REITs themselves are not subject to income tax. The tax is passed through to the holder. So if you receive dividends from a real estate investment trust, you're going to pay a higher tax rate than, say, investing in Pepsi or Coke or whatever on the dividends you receive from them. However, you may potentially qualify for a QBI deduction, which is 20% of your income, depending on your circumstances, but that's neither here nor there. Let's go ahead and check out Public Storage. Now, what are my thoughts on this industry as a whole? Well, first of all, I never understood the concept of storage. If you have so much junk that you need to find some place to store your crap, you should probably downsize or sell some of your stuff instead of putting it in storage because you're paying all that money. But I can understand if, let's say, you're going overseas for a year. Let's say you're in the military, or you don't want to have an apartment because you're doing something, and you temporarily need some place to put all your stuff. I could see somebody using storage for that. But a lot of people, they just use it for just storing junk, and they're paying a lot of money every month for it. Like, it's ridiculous to me. But anyway, people use it, and it can potentially make you money as an investor in a company that offers these storage units. So first of all, how big is this Public Storage company? Well, it's actually the number one in the United States. It's got over 205 million square feet of storage and over 2,800 locations. It's in 40 states, and they actually have an ownership interest in a company that's traded in Europe, and it's offered in, I think 7 countries in Europe. So you got exposure to the United States, basically the entire United States, and especially the big ones, California, Texas, Florida, New York, and you have exposure to several European countries. You're investing in the largest freaking company in the United States that provides this service. We also have extra space storage, which we'll look at in a second. It's actually growing a lot faster. This one has 180 million of square feet in 2,000 locations. And then the next one below that is U-Haul with only basically 80 million of square feet. So the two big daddies in this industry, the main rivals, are Public Storage and extra space storage. But you can also see that it's a pretty competitive industry. I mean, it's a place to store your junk. Look at all these different options people have to store their stuff. What makes Public Storage, unique and special? The orange color, I don't know. The donuts here are starting to really suck me in. So, like I said, it's offered in 40 states. You got to look at this from a population standpoint. Some states have very low populations. So you're like, oh, why aren't they in North and South Dakota and Montana or whatever? Oh, yeah, they probably have 10 people in each one of those states. But they're present in California, very populous state. Texas, populous and growing. Florida, populous and growing. Pennsylvania, and of course, Virginia. Oh, Virginia. I've actually seen these around, so I can confirm that they are in Virginia. But they're basically in the states that actually matter. So, how is the outlook for the storage industry? Well, according to iMark, the U.S. self-storage market is expected to grow at a CAGR of 1.86% from 2024 to 2032, reaching a size of $34.8 billion, or whatever that number means. So we have this one estimate from this one, firm that says 1.8% CAGR. Wow. And then we have from Mordor Intelligence Projects, I love the name, estimating the industry is going to grow at 2.44%. So it's a competitive industry. Public Storage is the biggest one, but they have a rival, Extra Space Storage, and it's hard to differentiate. I mean, what makes Public Storage special versus every other industry? They have a lot of dominance because they're the largest one, but it's a storage place. I mean, at the end of the day, it's a place to store your stuff, and other places can offer the same thing and potentially for cheaper, especially up and comers. So you look at it, and you're like, okay, the industry's not growing that fast. A lot of competition. Is it really that great? On top of that, we're going to look at the producer price index by industry. Mini warehouse and self-storage unit operators. This is basically the index of how much they're making from the cost that they're charging people. So you can see that over time, they've definitely increased prices for storage. You can see a big spike after 2020, and that's clearly because obviously we had inflation. But we can see recently that we're starting to have a little dip here. It's almost like the industry is starting to cut prices a little bit. It's almost like demand is starting to go back down. Now, is that temporary? Maybe. But, maybe people are starting to get squeezed by inflation a little bit. Like, if everything is going up in price and you're spending like $300 a month on junk in a storage unit, you might reconsider that lease that you signed with Public Storage, okay? So we see a downtrend in prices charged for storage. We see a slow-growing industry, and we see an industry with a lot of competition. I don't know what to say to that, but I would not. I'm not a huge fan of this stock personally. Okay, so let's go ahead, and I don't see a moat. So first of all, we have a market cap of $43 billion with trailing revenue of $4.58 billion and net income of positive $1.94 billion trailing. Dividend is 4%. Remember, the dividend, the stock price drops by the amount of the dividend. Basically, it's almost like your earnings yield, basically, because REITs have to pay out all of their profits as a dividend. So you can see roughly it's a 4% dividend, which is less than a treasury, but that's not going to last forever. Treasuries will come down. So right now you could buy a treasury and get a higher yield, but in the long run, I suspect that Public Storage will provide a better dividend or a better return, at least from income in the long run. We got a PE ratio of 27 and a forward PE of 26 and analyst price targets of $310.58, 3% upside. So we can see the stock price, it's up 22%, but when you factor in the fact that they're paying out most of their profits as dividends, you've had much higher returns than, 22.48%, probably roughly 40% over the last 5 years, which has trailed the S&P 500, I believe, but it's not a horrible return. Let's look at the growth of finances here. So we can see revenue, it grew pretty fast during the clown market, during the lockdowns, but it's starting to come back down, and I suspect if prices for rents charged for storage units continue to decline, like we can see in the PPI, revenue is probably going to keep coming down, flatline, or maybe even decrease a little bit. Now let's compare revenue growth to Extra Space Storage. Look at that difference. I don't know if maybe they did an acquisition or something. Maybe that's why it's up year over year, but that's pretty massive revenue growth. That's actually, honestly, it could be an acquisition. Let's look at profit margins. So Extra Space's operating margin is in the 40s now, the low 40s. Let's look at Public Storage. See how profitable they are. That's actually a pretty impressive profit margin right there. Operating margin. So actually Public Storage has slightly better profit margins, operating margins, than Extra Space. So it looks like Extra Space did a pretty big acquisition, and it actually drug down their margins. That's what I'm suspecting there. But overall, it's pretty tepid growth. Now, finally, we'll look at the financial statement. So this is the balance sheet for Public Storage. They've got cash of $271 million. They've got land that they paid $5.6 billion for, and buildings they paid $21.9 billion for. Accumulated depreciation is $9.6 billion. So keep in mind, when you depreciate, you're spreading out the cost of an asset over its useful life. If it's a tangible asset, it's depreciation. If it's an intangible asset, we call it amortization. So this depreciation of $9.6 billion can kind of show you how much of the asset's useful life has been used, and it's only depreciated on the buildings. Land is not depreciated. So if we look at it, roughly 9,671,521 divided by 21,97032, roughly 44% of all of the property, plant, and equipment that Public Storage has, that's the percentage that's been depreciated. So their assets aren't super old, and they're probably going to last for a long time on average. Now, if accumulated depreciation was a lot higher, you're looking at a company with probably a bunch of old buildings. So overall, their assets really aren't that depreciated. We can see some construction in progress. Basically, when they're making a building, all the cost doesn't get expensed while they're making the storage units. It gets capitalized or increased on the balance sheet on the asset side. And then once they finish constructing it, then it gets moved over to buildings once it's actually placed into service, and then it begins to become depreciated. But so far, these are just future costs that have yet to be expensed because they're not using the asset yet. They're not matching the expenses to the revenues. So this is public storage. This is storage units that they're building. Investment in unconsolidated real estate entities. This is their investment balance in that European company that they have an ownership interest in. It's like, I don't think they own it outright, but they have like a pretty significant interest. The reason I know they don't own it outright or have a controlling interest is because they would have consolidated it on the balance sheet had they. They got goodwill of $351 million. That's from acquisitions. As companies issue stock to acquire stuff and other assets. So they have total assets of $19 billion, and they got total liabilities of $9 billion. So overall, like they're not massively underwater when it comes to debt. So we can see that, they're partially financed by debt, but they're also financed by issuing preferred shares, which is like a steady dividend they have to pay. And they're not really using common equity that much. So most of their financing comes from preferred stock, which is just basically a dividend they have to pay forever, and then notes payable, which is debt. But, of course, that will eventually have to be refinanced. So overall, like, not the worst balance sheet in the world. They got a decent amount of cash, nothing really crazy going on, and not really worried about their balance sheet. So we can see revenues. Revenues are up basically tepidly for self-storage facilities, and this will probably flatten out or even drop if this PPI index actually applies to public storage itself. Ancillary operations is probably like package materials and stuff. More healthy revenue growth, but it's a small percentage of revenue. And they actually have pretty incredible, pretty crazy margins, as we saw before. Now, the one thing that I really noticed was we see an increase in interest expense. Interest expense basically doubled. Why? Because interest rates are higher. But the interest expense is not so high that it's anywhere close to bankrupting this company. Like their debt burden is definitely manageable. Okay, $67 million of interest expense on $1.1 billion of revenues ain't that bad. The majority of their expenses is their self-storage costs of operations, actually running the storage facilities. And they also have a lot of non-cash expense for depreciation and amortization. So overall, their interest or debt load's pretty manageable. They have a lot of preferred stock financing. But you actually see the cost of preferred stock because preferred stock shareholders get paid before common shareholders. So the net income allocable to public storage shareholders is $508 million in the most recent quarter. So you're like, wow, that's pretty good. They have high profit margins because their debt burden isn't that high. Well, yeah, because they have preferred stock, which they used to finance some of their operations or probably to acquire properties. And we can see that they had to pay $48 million of dividends in a quarter, right? In a quarter to preferred shareholders. That leaves $459 million of net income allocable to common shareholders. That's right. Preferred stock the dividends is not an expense. That's why it's not on the profit and loss. But it's important to know if a company has a lot of preferred stock because those dividends have to be paid first before you as the common shareholder receive that, okay? But generally, common shareholders have voting rights. And preferred stock doesn't really fluctuate that much in value. It's like a mishmash between a bond and a stock almost. It's like a third way. Okay, so overall, very profitable company. Just keep in mind the preferred stock. If they issue a ton of preferred stock in the future, watch out because that's a real cost. Let's see. Solid balance sheet, solid income statement. Statement of cash flows. Cash flows from operations are down slightly year over year, but that could just be a timing issue with the changes in working capital. Yeah, it looks like, accrued and other liabilities. So it looks like a timing difference. Let's see. They're investing in maintaining facilities, enhancing facilities. Let's see. What do they do? Development expansion. Okay, so they actually poured in about $84 million in the last 3 months into developing and expanding real estate facilities. So they're still growing. We can see that clearly. But that's easily financed by their operating cash flow. And we can see that, the vast majority of their cash is being paid out as distributions to preferred shareholders, common shareholders, restricted shareholder unit holders, and unvested VTIP unit holders. So, because it's a REIT, you can see that all the dividends are being distributed out. And if we go back to the income statement, let's see, do we see tax expense? I don't see tax expense. So, or I see a little bit of tax expense. That's probably for revenues that are like unrelated or something like that. But you can see the tax expense is like so minute that they're not actually paying the corporate tax rate on all of their profits. It's just a very small amount, probably because of some special reason. Or maybe it's foreign taxes, who freaking knows. But you can see because of the REIT structure, the tax expense is basically non-existent because all of the profits are required. I think it's 90% are being paid out to the shareholders, and that's taxed at the shareholders' marginal rate. So, with the QBI deduction, which is an additional 20% deduction, consult your tax advisor. So, overall, I mean, like the company has a solid balance sheet. They have they're high margin. They have a solid statement of cash flows. I don't see any massive red flags about this company. They're the largest in the United States, or in 40 states. But some of my concerns are the PPI index. We can see that, rental rates are starting to drop, probably because of inflation. We can see interest expense, while it's not huge, it's basically doubled. And we see there's a lot of competition in the industry. But overall, not the worst company in the world. I personally wouldn't invest in this thing. I'd rather buy VT than this thing. But, maybe I'm wrong. Maybe this thing has some secret hidden thing that's going to change the world and, make the stock vertical line. As a reminder, this was a sponsored video. If you want a sponsored video, you can send me $50, see the pinned comment below, and I will make a video on any topic that you want to cover. I am not going to do stock price predictions. If you want to buy my book, go to Amazon, type in Stop Being a Broke Loser, and buy my book. It's $15 or $13 or $14. Finally, if you want a private consultation with me, it's $75 an hour. You can send me the amount of money for the amount of time you want to talk to me, and we can meet over Zoom or whatever and talk about any topics that you want to discuss besides stock price predictions. Have a wonderful day.